All right, we are live. And for those of you that are watching us live, thank you for being here. We have a special show today. We have Ron Culver joining us, and he is a mortgage expert across Montana and really the country, doing some pretty awesome stuff there. So I'm going to bring in Ron, but if you have any questions, please make sure to put those in the chat. And also, as we get going here, if you have the second here, just put where you're watching from. So just curious if you're here in Montana or where you're at in the country or world and where you're watching from. But I'm going to bring in Ron here. And Ron, thanks for joining us. So you're muted. Let me unmute you real quick. There you go. So thanks for
Right.
joining us, Ron, and we appreciate you being here. So tell us real quick, just how did you get involved in the mortgage industry?
It wasn't by choice. So when I went to college, it was for a very, very different pursuit. I went to college for aerospace engineering, actually, and got almost done with that, and decided that that is not what I wanted to do with my career, and ended up double majoring in that and business management. Throughout my college career, my job was in the mortgage industry, primarily by default because both of my parents had been doing it since essentially before I was born. And it was a data entry type job to start out with very, very early, and then discovered that I kind of enjoyed it, was able to pay the rent with it, and pursued that instead of aerospace.
Okay. Yeah, and I'm assuming you're glad you went that direction.
I am. I do miss the what I think would probably be fun with aerospace engineering, but I thoroughly enjoy what I do. So yeah, I'm pretty
Yeah.
okay with that decision.
Every boy at heart has something in him that wants to play with rockets. So
Airplanes, rockets, space is pretty cool. Yeah, all the above.
yeah, absolutely. Well, I'm glad you got into mortgage just because over the last several years you've been a lot of help in my industry in real estate. So I definitely appreciate that. Now you're with Stockman Bank, so tell us what is your role with Stockman Bank? What do you actually do?
So I lead a team of real estate professionals in the Southwest region for Stockman Bank. Stockman Bank only does business in the state of Montana. They're Montana born and bred, and so in leading that group of individuals, I basically support them. My job is to make sure that they have everything that they need in order to do their job well, whether that's information, tools, resources. I will refill their copy paper, whatever's necessary to do to make sure they can provide that service to people looking to purchase or refinance homes.
Okay. And so you have that support role. You're leading, the team of lenders and all those supporting roles in here. So tell me about Stockman Bank. So obviously you're a huge bank, and you're only in Montana, correct?
We are, yeah. The bank has been around about 70 years. In fact, 70 years this year. It's primarily an ag bank, but we've got a very, very good, obviously, a real estate lending aspect to it as well. So I came on. I've been working with Stockman Bank for going on 5 years now, leading that real estate team. In addition to that, I'm on the secondary market committee, which basically is the committee that analyzes the market, sets the mortgage interest rates for the mortgage lending part of the bank. We work with different investors, identify different investors to find new products, innovative products, make sure our mortgage products are up to date and what meets the needs of the consumer. Because just like everything else in the world, consumers their needs evolve, they change. There's new things out in the market. There's new types of homes. There's new types of products, and it's our job to make sure that we are aware of those and making those available to the people so that they can take advantage of innovation in the industry.
Yeah, and it's always changing. And obviously one of the biggest changes that's happening right now is interest rates that those have been going up. So that's one of the main reasons I brought you here. And we have some people watching online. If you have any questions as we go ahead and put those in the chat. We're going to answer some of those at the end, and I'm sure some of them will get answered as we go through this today. But go ahead and put any questions you have for Ron or myself in the chat. And so outside of Stockman Bank, Ron, you have a a lot of different hats that you wear, and so you're part of. I want to make sure I get this right. You're part of the Montana Association of Mortgage Professionals. So tell us what that is and what do you do with them?
So I'm the president of the Montana Association for Mortgage Professionals, and if it's okay for here on out, I'm going to call it MAMP because that's a
Perfect.
mouthful. So I'm
It's
the president
too
of
many
MAMP.
syllables.
Yeah, and the purpose of MAMP is basically to provide, like I provide support to my real estate team, my real estate lending team within Stockman. MAMP is to provide support for mortgage professionals of all different kinds throughout the state of Montana. So whether you work for a bank, you work for a non-bank, maybe you're a broker, even partners of mortgage professionals, so title companies, escrow companies, real estate agents, all the different people that we work with together to do what we do. The organization MAP is the focus is to support them, and then one of the ways that we do that is advocacy. To be honest with you,
Okay.
I am not political. I am not a politician. However, I do recognize that within this industry, like probably every other industry in the world, politics play a part. There are rules, there are regulations. The mortgage industry is, if not the most, it is certainly among the most heavily regulated industries in this country. We have quite literally 80,000 pages at last count, somewhere in there, of federal and state regulation that we have to abide by. Some of those are great, some of them can stand some improvement. And so through MAMP, as well as the Mortgage Bankers Association, which is a national version of MAMP. MAMP is for the state of Montana. MBA, Mortgage Bankers Association, is national. Through both of those organizations, I do advocacy essentially. Just yesterday, in fact, I was in Helena, in the capital for our state capital for Montana, working with lawmakers, talking with them. We're in session right now. So the state of Montana, the legislature is in session, working with them to identify needs, identify changes and things like that. And then I also do that on a federal level in Washington, D.C., making 1 to 2 trips a year to advocate on a federal level as well.
Okay, well, we definitely appreciate that. And so, what's happening at the state level for legislation? Is there anything that they have coming up that they're working on that could maybe provide some relief to homeowners looking to get a mortgage?
Um, Hopefully, yes. I'm not going to say yes because, as you're probably aware, the legislative process is not something that's quick or efficient, and it's not to
Definitely
speak
not.
of our lawmakers because they've got a lot that they have to do. It just takes time. The process takes time. There's a lot of mortgage related and real estate related things going on, but a lot of it is administrative, like fees and making sure that those are kept under control and licensing and all that. One of the big focuses that we're working on a state level right now is it's a little bit cliche to say it because everyone talks about it, but it's affordable housing. It
Hmm.
boils down to in some of the larger metro areas within Montana, like Bozeman and Missoula and Billings, and even up in the Flathead area, housing is just it's expensive.
It
It's very,
is.
very expensive for a multitude of reasons that you could probably elaborate on better than I can. But the fact of the matter is, if you look at the average income of your average Montanan versus the average sales price of a home, there's a disconnect there. It's very, very difficult for someone with an average income to be able to afford kind of the average house. And so from a political standpoint, from a state standpoint, there are attempts to try to address that. And one of the ideas that's being thrown around is there are things called down payment assistance programs, commonly referred to as a DPA or down payment assistance. And what that is usually a nonprofit organization. Sometimes those nonprofits might be attached to a municipality like the county or the city or something like that. Sometimes they're truly nonprofit organizations, businesses that are there to help those in need who qualify to get a down payment. So you may not have a down payment, the minimum down payment necessary to purchase a home, but if you qualify, and that has to do with income and residency and things like that, there are organizations out there that will help you with that down payment. The problem with it is most of those organizations have an income cap, which I think is a good thing. So if you make too much money then you don't qualify. And realistically, so you don't want someone that's out making a stupid amount of money that can afford to buy a house on their own, taking up either public funds or privately donated funds of a nonprofit for a down payment. So you have to be able to qualify. The thing
Okay.
we're running into is if you fall within that qualification, maybe you make up to a certain percentage of the area median income for that given area. That's great. You can qualify for that DPA program, that down payment assistance. However, even with that, your income may not necessarily support the mortgage on the house that you're looking for. And the disconnect is some of these larger metro areas within Montana have really expensive homes, and there's still a gap there. And so one of the ideas is take a closer look at these DPA programs and apply some geographical rules to them. So that maybe one of them says you can make no more than 80% of the area median income to qualify. Well, that
Okay.
might work in some rural areas. That might not work in some place like Gallatin County, where Bozeman's at. And maybe there's an opportunity, and it's an idea, so we don't know yet, but maybe there's an opportunity there to increase that from 80% of the area median income, maybe to 100 or even 110 or 20. We have to figure that out, and we have to figure out where the money's coming from and apply those potential changes to the right area, to where you're not you're not making it too easy, so to speak, in a rural area where values aren't as high, but you're making it appropriately easy for the areas that need it.
Yeah, I think that makes a lot of sense. You have to, be able to qualify for it, but if you can qualify and that still doesn't help you get the house, then it's kind of pointless. So that
Agreed.
makes sense if you can tailor it for the specific markets that people are trying to buy in.
That's the hope. If the entire state was relatively homogenous when it comes to values and things like that, wouldn't be an issue. But the fact of the matter is, for someone either living in Montana or moving to Montana, not everyone wants to live in an extremely rural area where it's you've got fewer resources at your fingertips than in a larger area like a Missoula or a Billings or a Bozeman. And then obviously some people do want to live in those areas, so we just want to make it available to all individuals appropriately, regardless of where they want to live, and not pigeonhole them and say, hey, you have to live way away from the city areas where a lot of the jobs are, just because that's the only place you can afford.
Yeah, and it just varies so much from the state. You have a market like Miles City on the east side of the state, and the housing prices there are just so drastically different than the western cities like Kalispell or Missoula or Bozeman. So, I mean, they shouldn't be treated the same. It's essentially a different state.
Agreed. Yeah, it's one of the wonderful things about Montana is you've got a wide variety. If it's not just the cities of small towns and large cities. You've got, if you want to be out on the eastern side of the state, like where you're mentioning with Miles City, then you've got high desert type environments,
Hmm.
which is awesome. Versus Southwest Montana, you can't open your eyes and not see mountains. So a little bit of everything for everybody, and that's a great thing. And we want to be able to provide financing for homes in all of those different areas for all the different types of folks that want to live in Montana.
Yeah, and that helps with one piece of it, and another piece of the home affordability right now that everybody is struggling with is the interest rate increases. So how does that all work, and what's kind of the driving force behind the spike in interest rates?
Gosh, that could be about a 3-hour discussion in and of itself. But
Yes.
you're right. The interest rates, not only are we dealing with expensive homes, we're dealing with interest rates that have gone up, to be honest, relatively quickly if you look at it from a historical standpoint. I mean, so for instance, today we're seeing longer term interest rates on longer term mortgages, like a 20, 30-year mortgage, in kind of the where are we at? We're in the low sixes, like 6 to 6.25 or so, and that's not unheard of. If historically, if you go back 50 years, that's actually a really, really good rate. We stayed a long time. When I bought my first home, we were a long time in that 7 to 8% range, and that was quite normal. No one batted an eye about it. Back in the 80s, we're pushing 20% on interest rates for homes. So realistically, where rates are at right now are pretty darn good, and
Hmm.
it's still a great time, it's still a great opportunity to buy a home. But if you look at recent history, just in the past, year and a half, the rates that we're dealing with today are significantly higher than what they were, and so there's a little bit of shell shock with that. Just speaking in numbers, the general consensus is for about every 1% increase in interest rates, there is about a 10% decrease in home sales.
Wow.
And if you look at the payments on that, every 1% increase, if you go to the maximum conforming limit, just north of $720,000 for a non-jumbo, a conforming agency type loan, a 1% increase in the interest rate, depending on the loan amount, is going to be anywhere from $450 to $470 a month that you're paying more with that increase in interest rates. So
Wow.
if you go back over the last year and see depending on what time frame you're looking at, it could be as much as a 3% increase in what the rates are. That could equate to $1,200 a month on the same mortgage, depending on what you got. So it's impacting it. As far as what's driving it, it's really interesting time. So I'm one of those geeks that looks at market data pretty much minute by minute. I've got a dedicated screen on my computer at my desk that's up all the time. And I glance at it constantly. And markets change quite literally minute by minute. And one of the things that we have right now is volatility, where rates may be somewhat even keeled throughout the day historically. And in some days right now, those interest rates are changing minute by minute. So if I get someone who calls me and says, "Hey, Ron, I want to lock my loan, I think, what's rates at today?" I can quote them a rate based upon that moment in time. And if they say, "All right, you know what, I'm going to talk to my wife and make sure she's cool with it. I'll call you back in 30 minutes and then we'll go from there." They call me back in 30 minutes. Those rates could have changed, like significantly in some cases. What's driving it? Historically, the drivers for that stuff is the domestic economy, things that impact not just the stock market, but the bond market as well. So employment numbers, inflation numbers, CPI numbers, GDP numbers, all of these things that economists like to talk about 24 hours a day, they all impact that, and they still do to this day. However, what we're working with now is we are truly in a global economy. So not just the domestic numbers are impacting interest rates, but international as well. I get up. I'm one of those early birds. I get up relatively early in the morning, and one of the first things I do after I pour my cup of coffee is look and see how markets closed in the Asian markets, for instance, and the European markets, and because that kind of gives me a little bit of an idea of what might be happening when our domestic market opens. Those international markets are impacting our rates, our domestic rates, and then the other one that's a little more recent even than that is geopolitical. So what's going on in Ukraine right now? What's going on in China, Taiwan right now? What's going on in North Korea right now? All of that is also impacting mortgage rates. And so the conventional wisdom that we used to follow when it comes to domestic economy, while it's still there, it now has major influences internationally by both international economy and geopolitics as well.
Yeah,
Complicated.
it's amazing how everything's just so intertwined, and it's not just straightforward. And I know people always see in the news that the Fed is raising the interest rates, but they're not talking about mortgage rates. Is that correct?
I think it's probably a secondary conversation. There are still discussions about it. It pops up because, as we all learned in about that 2008 timeframe, mortgage rates, the performance of mortgage loans after they've closed, that all impacts our economy significantly. So the discussions are happening, but I think the Fed is taking the primary role in discussions right now, simply because they have got a very, very big job in combating inflation. And so, yeah, we have seen pretty significant increase in Fed funds rates over this past year. The general consensus by people that are a lot smarter than I am in the economy tells you that we will continue to see those rates go up in 2023. I think that the pace that they're going to go up will slow. I believe that we will probably see less drastic increases at any one given time. Instead of 0.75% at one time, maybe we're going to see 0.5% like the last one, or maybe 0.25%. But they're still anticipated to go up. And that could negatively impact mortgage rates as well. I think if you were to ask 5 people that were very, very smart in this, they would probably tell you, all 5 of them would probably tell you that interest rates still potentially could go up in 2023. The likelihood of that happening is significantly greater than them going down in 2023 anyway.
That's good to know for anybody that's thinking about buying and, trying to time the market. If we had a crystal ball, it would be really nice, but, we kind of have to go off, little bits and pieces of whatever indication we can get. So it seems like the interest rates have peaked and have started coming back down a little bit, at least. Do you think we're past that peak, or do you think it's a dip and we're going to see it come up more as they try to get inflation under control?
I hope we're past the peak. Um, I'm not all that optimistic. I think given what the Fed is going to do, I think what the Fed may need to do this year might cause another spike. And
Okay.
I say that I say that with I'm not happy about it by any means. I hope it doesn't happen, but I think
Nobody is.
it's realistic. Yeah. So we're not dealing with just inflation here, although that's obviously a very big one on the domestic economy. But one of the other things that we have to keep in mind during the pandemic, one of the ways that the federal government tried to keep the economy going was what they called quantitative easing, and that encompassed a whole lot of different things. But one of the things that encompassed, they bought billions of dollars worth of mortgage-backed securities each month. And what a mortgage-backed security is, when someone like me closes a loan, or when Stockman Bank closes a loan, those are oftentimes sold on the secondary market. And you get these aggregators who get all of these little individual loans, and they put them in a bag of loans. That bag is then securitized into a bond, essentially a mortgage bond, and it becomes a mortgage-backed security. So you've got a bag of hundreds of millions, if not billions of dollars worth of loans of similar characteristics. Historically, the government was not the primary purchaser of those. They would go to private investors, they'd go to investment banks and things like that, and they still do to this day. But during the pandemic, the government was the one that was writing big checks to purchase those, because it was infusing money into the economy. And realistically, being dark times in history, it kept us going. Fast forward to today, the government has billions and billions, I believe trillions of dollars of these mortgage-backed securities, and they're not in the business of buying these. They did it to stimulate the economy. I think it was probably a necessary thing. It probably had its intended purpose. But in the grand scheme of things, the government doesn't do that. That's not their primary, that's not what they like to write checks for. So over the coming year or 2 or 3, however long it takes, they're going to sell those off. And even if inflation gets under control, the selling of those mortgage-backed securities back into the private market could also adversely impact interest rates. So we've got that to deal with, in addition to the getting the inflation under control. That could lead to another spike.
Yeah, absolutely. Just a whole lot of baggage to deal with there. I think when people hear about, mortgage-backed securities, their mind, at least mine does, automatically goes back to 2008 and the crash and everything that happened with mortgage-backed securities then. So hopefully we learned a lot from that and don't make the same mistakes that were made before.
I don't think that we're going to. You're absolutely right. Making that mistake again would be absolutely catastrophic. Potentially even more so the second time around. The good news is what happened then is not what is happening now. That occurrence in that 2008 timeframe was primarily driven by really bad quality loans. Loans were being made to people that should not have been made, to people who should not have gotten a loan. And the default rates were astronomical. And that has a snowball effect. And we can go into detail on that if anyone wants. But realistically, that's not what's happening now. The loans that are being made, and the loans that have been made, especially over the last 2 years, when, let's be honest, the mortgage industry was doing very, very well and was very busy in 2020 and 2021. Those loans were higher quality, like significantly higher quality. People that were getting them great credit. They had good income. They were the type of people who deserved to get a mortgage loan and deserved to get a home. And we don't have those default rates right now. We have higher interest rates, but the rate of which people are defaulting on their mortgage loans and not making their payments is in line with what it should be. It's very, very low.
Yeah, and that's a really good thing that we're not seeing those foreclosures like we saw before. I got a call from a guy just last week that was asking me, about foreclosures and wanted to buy foreclosures, and like we just aren't seeing very many of them, and when we do, they aren't really discounted. So that's a really good thing that we're not flooding the market with that foreclosure property that we saw back in the '08 times. So
You're absolutely right. And we get the similar calls. So I think for investors that are in the know, they're aware that banks in general oftentimes have what's called an REO portfolio, or real estate owned. And real estate owned is essentially a property that a bank has had to repossess, for lack of a better term. And that's a horrible term, horrible word, but it's true. People that don't make their payments, just like on a car can get repossessed. A house can too. Historically, investors were aware that banks had these REO portfolios, and oftentimes they could call a bank and say, "Hey, can you send me your REO list?" And they get this, nice little Excel spreadsheet or hard copy or something, and there's a whole list of homes on there that the bank has had to take back and is probably looking to sell at a fairly decent price just to get them off their books, because banks are not in the business of owning homes and maintaining them and doing all that stuff. And we, Stockman Bank, just like most other banks, at least in our market here in Montana, we don't really have an REO portfolio. I mean, onesie twosies here and there, maybe, but even that, like, it's not a thing.
yeah, and I think that's a really strong indicator of just how strong the housing market is currently, that not seeing those properties get repossessed and all those foreclosures hitting the market. There's a lot of good in the housing market right now, and I think that's providing a cushion for everything to happen safely as far as interest rates go. But getting back to interest rates, a lot of people are trying to buy houses right now, and with rates higher than they were before, the housing prices haven't come back down. So what are some ways that people can deal with these rates and maybe reduce that interest rate when they purchase?
Um, there's a couple of ways to go about doing that. There's, like any industry, there's the flavor of the week, so to speak, or the buzz, all the product that everyone's buzzing about. One of the more popular things right now that I get a lot of questions on, I think a lot of folks in the mortgage industry do, is called a 2-1 buy down, or a buy down of the interest rate. And there's two different types of buy down. The popular one is this, they call it a 2-1 buy down, or a 3-2-1 buy down. And basically what that is it's essentially prepaid interest. So if you lock in your loan at, let's say, 6%, then the investor who ultimately purchases that loan, now maybe the bank keeps it, maybe they sell it off, it doesn't matter. There's an investor, and like I said, that could be the bank that you go to, or the mortgage company that you go to. They keep it. They are the investor. Maybe they sell it off. Either way, that investor is looking for the interest income on that loan. So an investor will buy a loan or a bag of loans, a big group of loans, because what that affords them for their money when they purchase it is a payment stream every single month for conceivably 30 years or 360 months. That payment stream includes principal and interest. So when a homeowner makes the payment on their loan every month, it includes, among other things, principal and interest. That goes to the investor. A buy down is the option to essentially prepay that interest. So the investor still gets their interest. And in the example we use, 6%. However, if you prepay that interest up front, investor still gets it, but for a temporary period of time, you actually get to pay less. So these popular things called like a 2-1 buy down, for instance, is for the first year, your interest rate that your payment is based upon is going to be 2% lower than your note rate. So if you get it locked in at 6%, the payment for the first 12 months of that loan is going to be based on 4% or 2% lower than the note rate. The next year is where the one comes in on a 2-1 buy down, and it's 1% lower than the note rate. So 5% would be used to calculate your payment. Now, the investor, they still want their 6%, and they're going to get their 6%. But what happens is there is an upfront lump sum payment essentially made to the investor that makes up for that 2% less the first year and 1% less the second year. And the way that is being made right now are sellers. Sellers oftentimes, to provide an incentive for a buyer to buy their home, will say, hey, you know what? I will do a contribution towards the loan. I will offer up some money to cover the cost of that 2-1 buy down. And it oftentimes allows a seller to get a great price for their home, help out and incentivize a buyer a little bit. And what that ultimately does is allows that first couple of years on the mortgage payment for the buyer to be at a little bit lower rate. And that's great. By the third year, you're back to the note rate. You're back to that 6%. That's called a temporary buy down or a 2-1 buy down. The other type of buy down that folks are talking about is a more permanent buy down. So interest rates are a commodity, just traded on the secondary market, just like frozen concentrate orange juice and gold bullion. So if you want to get a lower interest rate, there's a fee associated for that. So like it's a commodity, everyone wants a lower interest rate. So, Kyler, when I, go out and have a drink with you, I want to be able to belly up to the bar and order a pint and say, hey, you know what? I got a lower interest rate than you do. I'm cool.
Yep. All about the bragging rights.
Yeah, exactly. The bragging rights. To be able to get that, oftentimes I will probably have to pay a little bit more. It's a more attractive product to me as the consumer. I want to pay 5% instead of 6%. To do that, I have to buy the rate down essentially by paying a higher fee for the rate. So you go to the car dealership and you can buy the base model car with not a lot of bells and whistles, or you can buy the same car with all the cool options on it. All the cool options cost more money. Same product, same car, but cost more money. Interest rate's kind of the same thing. If you want a lower interest rate, it's going to cost a little bit more money than a higher interest rate. That costing more money is an upfront fee that you pay at closing. Sometimes you can wrap it into the loan amount. Sometimes you can't. It just depends on the individual process or transaction. And you get that lower interest rate. The difference between that and the temporary 2-1 buy down we talked about is that lower interest rate lasts the entire term of the loan. So if you have a 30-year loan, you get that lower interest rate for the entire time.
Yeah. So a couple different options for, different strategies. Obviously one would possibly be better if you're planning on living there a long time. And one, if you're only planning on living there for a couple of years or maybe planning on refinancing down the road. So it's good that there's options out there. And that's one advantage that we're seeing coming back into this market. When we look back, even just a few months ago, seller concessions weren't an option. You weren't going to get a credit that you could use for a rate buy down or for repairs or anything like that. So having that come back now that the market is slowing down a little bit, mainly because of interest rates, it's a really nice thing that we can kind of combat that higher interest rate. So thanks for sharing about that. Another popular question as far as home affordability goes is with how much homes are costing now. Everybody has that 20% number in their head for down payment. So we have a lot of programs available to us that don't require that 25 or that 20%. Can you talk a little bit about that? What's a realistic down payment that somebody needs to shoot for?
You're right. There's a lot of different options, and the down payment that you want to shoot for is going to be dependent upon each individual person. The good news is we do have options. We didn't used to. That 20% kind of conventional wisdom about, if you want to buy a house, you have 20% down. If you go back to the older generations and, maybe it's the baby boomer generation, maybe it's the greatest generation and so on, it's dated. And it's not to say it's not accurate, because if you can put 20% down on a mortgage, that's phenomenal. It's a really good thing. But you don't have to. That's the point. There are different programs out there. So for instance, there's two what they call GSEs, or government sponsored enterprises, that are primarily known. You hear about them in the news, Fannie Mae and Freddie Mac. they're the largest buyers of mortgage loans out there, and their programs drive the mortgage market in general as far as what they require. They have programs that you can put as little as 3% down. So 3% down payment plus things like closing costs and all that. If you qualify, I don't want to make it sound as though everyone has that option, but it is an option for a great number of people. It can be as low as 3% down. There's the Federal Housing Administration, FHA is what it's typically called. They have a 3.5% down option as well. And FHA loans, they have their own unique niche in that they kind of cater to first-time home buyers. You don't have to be a first-time home buyer to get it, but it's kind of what it caters to. They obviously cater to the lower down payment with only 3.5% down. They cater to credit scores that might not be, perfect. You can have a little blemish here and there and still qualify for an FHA loan. And then there's a couple of very unique ones for those individuals who are either currently serving our country in the armed forces or are veterans of the armed forces. They have served our country and have since retired from the military. If they qualify through the Veterans Administration for VA benefits, VA offers a 0% down or a 100% loan to value loan. And that's something that is unique only for those that are either actively serving or have been veterans of our military. And it's a phenomenal program. If you're a veteran and you have veteran status or you're active duty and looking to buy a house, absolutely something you should be looking at first and foremost, because it's a fantastic product available to you and only to you guys. If you're not a veteran, it's not available. The other one is
the huge benefit.
It's a massive benefit. And every time I get a call from either active duty or retired veteran, it's the first place my head goes, and I smile every time because I think, man, I'm going to be able to help out this individual with something that I can't do for everybody. It's probably going to put them into a house because it's awesome.
Yeah.
The USDA, United States Department of Agriculture, not something you probably oftentimes think about when talking mortgages, but they have a program called Rural Development. Or RD is what it's referred to as a lot. And it is also a 0% down program. You do not have to be a veteran to get an RD loan. The difference is that it's also got its own niche in that RD programs are typically not available in urban areas, hence the name Rural Development. They cater to things that are hard to get loans on otherwise, higher acreages. Finding a home that is in a rural area that it's harder to find financing on, because part of getting financing is getting an appraisal done on a home to determine its value. Well, the way they do appraisals is they will compare the subject property that we're talking about, to other properties that have recently sold in the immediate geographic area, hopefully within a mile. That doesn't always happen, especially in Montana. But when you get out in these rural areas, maybe you're trying to finance a property that's on 60 acres out in Wilsaw, Montana, and there's no recent comps, especially with something with a higher acreage. Maybe you have to travel a lot farther to find a comparable sale and so on. RD caters to that a little bit more, and they do have a 0% down option. Rare, but you can use it. So no, 20% not required. 20% down, awesome, but not required.
Great. And it's so nice to have all those different programs. And I know RD is starting to make a little bit of a comeback. They went away a little bit as things got crazy in the real estate market, as everybody was looking for conventional buyers. But we're starting to see that come back, hopefully, because it is a great program and it is widely available. And when you talk about rural, it's not necessarily all the way out in the country. From what I've seen, it's almost everywhere outside of city limits, at least in the Bozeman area. So really great option there as well. So is there anything else that, as somebody's looking to buy a home in Montana, is there any other things they should be aware of right now, and just kind of how to navigate the mortgage world?
Yeah, there's definitely tips and tricks. Whether it's a crazy market because there's houses are being sold every 4 seconds, or it's a crazy market because it's taking a while to find a home or whatever the case, and that 4 seconds turns into 4 months.
Yeah,
There,
which we're seeing.
yeah, exactly. It's very, very obvious on our end, um, who is getting, the type of buyer that is having more success. That type of buyer is the type that shows up and starts working with a mortgage lender before, or earlier on in the process, I should say. Oftentimes things come up and you're driving by and you see a house for sale and you're like, oh my gosh, that's it, and done. Like, you've decided at that moment, I'm buying that house. That's great, but not everyone has that luxury. And one of the best tips and tricks of the industry in the last, almost 30 years that I've been doing this, is working with a mortgage lender earlier on to get pre-qualified. Navigating the mortgage process, it's it can be cumbersome. It's complicated. I mentioned that we've got a whole lot of federal and state regulations that we as mortgage lenders have to abide by. There are hoops that we have to jump through. There's waiting periods that we have to abide by. There's qualification standards that buyers or people refinancing an existing home have to fall within. So meeting with a mortgage lender ahead of time, earlier in the process, when you start to say, okay, it's probably time to buy a house, helps that. You get pre-qualified, and you're able to take a good mortgage lender instead of just taking the buyer's word for it on how much money they make and how much debt they have. Someone who is real diligent about it and is thorough will start to work with you, get documentation like income documentation, bank statements, pay stubs, and tax returns and things like that, finding out exactly what you can qualify for based upon your legitimate income, your legitimate monthly expenses. Maybe you've got a car loan, maybe you've got a credit card or some student loan or whatever the case, and saying, hey, okay, here's the deal. We can totally qualify you. Here's the amount we can qualify you for. If you've got a 10% down payment, that's great. That means that you're going to be able to shop for a house in, the sales price of about this. Go shopping, because we know as long as it's within that, you're good. And doing that work up ahead of time or prior, earlier in the process, makes for a much, much more successful process down the road.
Yeah, absolutely. And that's such good advice for anybody that's looking to buy a home. And we always try to get people involved as early as possible in the mortgage side of it, just because, you have a tiered credit system to where, you know, maybe you can get up into a slightly better tier for an interest rate, or, maybe there's fraud that if we find it early, we can address it and combat that. Where, I've seen it over and over again where people don't want to get pre-qualified and it ends up coming back to bite them. So definitely get involved in that early. That's great advice. Thank you.
Mhm.
And
Yeah,
so,
you're absolutely right. When it comes to, you mentioned fraud, a lot of times people's credit reports have been compromised and they have no idea. And you don't learn about that until you go to buy something. Maybe it's, you're going
yep.
to go buy a new pickup or something, or a house, and then they pull the credit because, we've got to verify that there's where your credit profile, what it looks like. And if there's fraud on there, that's terrible. It's not any fun, but oftentimes that can be fixed. It takes time. It's not something that if we find out about it on Tuesday, it's done by Thursday. So getting ahead of that is,
Unfortunately, you can't
yeah.
just hit Control Z on that. So
I've tried. It doesn't work.
bummer. But looking forward, Ron, I know you don't have a crystal ball, but what would you expect to happen with interest rates in 2023 throughout the rest of this year?
Um, Best case, in my opinion, best case is they stay the same as they are today. I don't believe there's much of a chance, of a viable chance of them going down. Worst case, I think they can go up a little bit more. I don't know that we're going to see the stratospheric race upward in them that we saw in 2022. However, I see the possibility for them to go up a little higher than they are today, right, throughout the course of 2023. Like I said, best case, I think if they stayed where they're at, that would probably help. Like I said, they're not as low as they were, a year and a half ago, 2 years ago, but it's still not bad. I mean, interest rates in the fives, interest rates in the sixes. Historically, if you go back 50 years, we're still well below the historic average for interest rates over the last 50 years. And people have been buying homes for 50 years, and they've been realizing some fantastic appreciation and generational wealth building by buying homes at interest rates significantly higher than they are today.
Yeah, absolutely. If the numbers make sense, it's almost always a good time to buy real estate as long as you're going to hold on to it. So,
Agreed.
um, let's see here. So we talked about that. So if somebody's looking to get a mortgage, what's the best way for them to get in touch with Stockman Bank?
Um, Stockman, like many other banks available or other mortgage lenders out there, has multiple avenues. It depends on what you like to do. If you're like me and you're kind of an old school handshake face to face type individual, you can walk into any Stockman Bank branch anywhere that we have one in the state of Montana, ask to talk about mortgage lending. And for the most part, there's probably a lender on site. If they're not, then we can make an appointment, come back at a different time, get you on the phone right there in the branch with the lender. Maybe they're out to lunch. I know most lenders that I work with, either on my team or other teams within Stockman, they've got a cell phone on them and they're willing to use it pretty much any waking hour of the day to talk about mortgages because we all love to do it. We have a website, just like anyone else out there. You can go to a Stockman Bank website. Let's say you're looking for a house in Havre. You pull up the Havre branch, find out who's working there. You can send them an email. You can give them a call. We have online application links as well. If you want to get started and you know you're going to be, hey, let's get this rolling, man. Let's get pre-qualified. I'm going to go talk with my real estate agent and go look for a house, but I want to know how much house I can look for. You put in an application right off the bat. We have options for a completely digital experience. If you're not one that wants to come into a branch and talk to someone face to face, totally fine. We have a completely digital experience, which works every bit as efficiently as face to face. There's multiple avenues depending on what you like for that. The beauty about working with Stockman, or as much as I would like the business by all means, because I think we're phenomenal at it. Let's talk about a local lender in general, because there are other great financial institutions out there besides Stockman Bank. Just because I have a bias because I work here, I have to acknowledge there's great ones out there. Local lenders are a big deal in Montana, in my opinion. It's not just because I am one, but one of the wonderful things about Montana and its uniqueness is also can be challenging when buying a home. So if you have a national lender who doesn't have boots on the ground in Montana, then they can oftentimes struggle with things like appraisals on homes. So if you get an appraisal done on a home, I mentioned one of the things that they have to do is look at comparable sales by other homes that are similar in nature and hopefully geographically close, so they can say, hey, this 3-bedroom 2-bath at 2,800 square feet that you're buying here, to determine the value of that, I want to look at another 3-bedroom 2-bath 2,800 square foot or close house that's hopefully in the same neighborhood, at a minimum hopefully in the same town or city. And oftentimes in Montana, that's not available. You might have to go to the next city over, which might be in the next county over in Montana, to be able to find something to say, yeah, I think this house is going to be worth X because this other house that sold is worth about the same and it's pretty similar. National lenders don't get that. If they see a comparable sale on a house that they're using to index the price of your potential home off of in a different town, potentially in a different different county.
Hopefully not a different country.
Hopefully not a different country. No,
We are close to the Canadian border, though.
We are, but we're not going to be using comps from there. So yeah, my mistake. Different county. They could potentially have a problem with that. We have picked up a number of customers that have come to us because a national lender took a look at the appraisal on the house they were trying to buy and said, no, are you kidding me? This place is miles away in a totally different county. This is a horrible comp. No, absolutely not. You come to a local lender and for instance, Stockman, I can obviously speak to, and I believe it's the case with some of our other local lenders around here, competitor banks and things like that. Our loan officers are primarily, at least on my team specifically, and most of the team, are Montana born and raised. They've been here their entire lives. The people who make decisions, they're called underwriters. They're the ones that make sure that all the I's are dotted and the T's are crossed, and to say, yeah, we can approve this loan. Within our institution, Montana born and raised. They understand this market. They know that just because this comparable sale on this appraisal isn't right next door, that's okay, because there is no option right next door. We do have to go to the next town, or maybe that's in the next county over. They're able to understand that much better. The bigger national folks have a harder time understanding that, because they don't know Montana.
Yeah, and I've actually seen that quite a few times over the last several years, to where the national lender had to get bailed out by the local lender, and pick up that loan and put the pieces back together, just because for whatever reason they weren't able to get it done. So I think that's really great advice. And if you have any questions for Ron, go ahead and leave them in the chat. We're watching that right now. And if you're watching the replay, still leave a comment. I'm going to do my best to get back and answer those. I'll be monitoring those after this is done. But we do have a comment here from Brad. He left this on Facebook. He said, "Will it ever drop? Is there a crash in sight?" And I know that that's everybody's biggest fear right now. So we are seeing a little bit of a drop right now. I think we're past the peak of where the market was as far as home prices go. But as far as a crash in sight, a lot of that is just supply and demand. And at the end of the day, there is so much buyer demand, even still in this market with higher interest rates, that I just don't see a crash coming. Certainly not like we saw, in the big crash back in 2008. Just because, I mean, it's easy to get employed right now for the most part, and people aren't having that default rate. So, what are your thoughts on that, Ron?
Kyler, I agree with you. I mean, things are different today than they were back in '08. There's so many people, both within the industry and outside of the industry, trying to compare what's going on today with what happened in '08. And we're talking apples and oranges here. It's a very different scenario. I agree with you. I think that the crash that everyone is afraid of, I think, is much less likely to happen than it did the last go around. And taking that one step farther, I believe that Montana specifically is insulated to some extent from trends nationally. If there is a crash, which there again, I don't see that happening. But if there is a crash, I believe Montana is somewhat insulated. We live in one of the most desirable places in this country to live. People want to live here. People that are living here want to stay here. That creates, to your point, that's a supply and demand thing. We're still having, there's a lot of people looking for homes, and not as many homes necessarily available today as people that might be looking for them. And I think that's going to insulate our values, and it's going to continue to make Montana a strong housing market, and there again, building generational wealth. It's hard to go wrong with real estate, especially in Montana.
Yeah, and we definitely saw that insulation in the last crash. We weren't hit nearly as hard as other places. We were still hit significantly, but it wasn't like a lot of these, especially bigger cities, where you're getting everything boarded up, and it's just a ghost town. So we definitely have a little bit of cushion here with the national park and college and everything that Montana has to offer, and just the lifestyle that comes along with living in the Rocky Mountains. So, well, that's all I have for you, Ron. I really appreciate you joining us today. If you have comments, please leave them. We're going to be monitoring those afterwards. But thanks again, and I'll catch y'all on the next